Welcome to the Moneymakers. I'm Bruce Whitfield. Yesterday we had three bright minds looking at the year that was, but it doesn't take a rocket scientist to look back. We need rocket scientists to look forward. So what does 2016 present? Adrian Saville, Chief Strategist at Citadel and Canon Asset Managers, Peter Armitage, the Chief Executive at Capital and Andrew Flavell, Wealth Manager at AlphaWealth. We were talking last night, it just got interesting, and we were talking about how to treat 2016 for investors. The message was, don't go passive. In other words, if you are in a Satrix 40 product, well then do diversify. And Andrew Flavell's comment there was, well, the moment you start dabbling then in the different Satrix products, then you become an active investor. And then what is it all about? Adrian Saville, let's start off with you. So how do we treat 2016 as Joe Schmo investors?
Tough economy. The circumstances will be made harder by rising interest rates. I think you'll see an interest rate hike at the end of January. Right now, given where the rand is, I would say it could be as much as 50 basis points. Yeah. The economy, if it isn't in recession, spends most of the time flirting with recession. So somewhere between 0 and 1 economic growth would be good. And inflation, because of the rand fallout, heads into 7%. Early 2016. That's a horrible place to be.
That is historically, under those sort of circumstances, markets have dramatically underperformed. Right?
That's called stagflation.
Yeah.
It's a tough landscape. To me, the question is not, what is that economic outlook or macroeconomic outlook? The real question is it priced into the market? And if it isn't priced in, where will we find those opportunities? A place that we were very successful in 2015 was in mid and small caps. We spoke in the previous show a lot about the large caps that did all of the lifting or all of the falling, Lonmin, Anglos, Naspers, SAB Miller and so on. We didn't really touch on the mids and smalls, and we had a great time with mids and smalls in 2015, beating the market by 11 percentage points. I would use that as a way to add diversification to the portfolio. Andrew made the point about uncorrelated or low correlation with your different assets. Mid and small caps are a good place to go.
So it's the return of the small cap fund in 2016. Peter, I mean, you like that space, don't you? I mean, that's where the retail investor likes to play. Generally, that's where you get lots of opportunities to buy shares that are undervalued and opportunities to sell them when they're expensive.
Yeah, I mean, we don't, so we haven't had too much exposure to small caps. We've had a lot of mid-cap exposure because there's opportunities where...
Okay, let's just clarify here. A small cap is anything out of the top 100?
Well, probably less than $1 billion, eh? How would you define it?
Yeah, for the sake of this argument, I would say that large cap is your top 40, mid is 40 to 100, and small is anything outside of the 100.
Sure, fair enough. So our view is, from an economic point of view, quite similar. So we want very little exposure to things like retailers and banks, although there will be points in time, especially if I think interest rates could go up more. I think if they put interest rates up 25 or 50 basis points, the rand will weaken because the logic is completely the opposite of that. But I think foreign markets will say to the Reserve Bank, that's not enough. That's what tends to happen. So we want, and then you can have this kind of spiral that goes on. So your tail risk on the one side in terms of the local economy is, and inflation could be a lot higher. So we want to avoid all banks and retailers, although they can get to prices where you they become stuff you have to buy.
I mean, pre-Nene, Standard Bank was over 130, it's sitting at 100.
Sure.
First Rand was over 50, it's sitting below 40.
But the cost of capital, and we would argue that that's sort of an appropriate adjustment. So our positioning is to stay in some, and in fact of our top 10 shares going into 2016, 8 of them are effectively foreign shares. So effectively not playing the South African market game, and less shares get to price levels at which they become kind of no-brainers.
And now the people watching this going, okay, so I must take all of my money out of the country now at 18.
I'm talking about shares on the South African market.
Oh, okay, so the Richemonts of the world.
So Naspers, Astoria, which is something which we helped list and we're the asset managers of. So not surprisingly, we back ourselves to do that.
Surely you have the currency conversion in there, so effectively you are converting it.
Yeah, no, absolutely.
Bruce's 17 or so.
So our view is you want to have offshore exposure. The currency becomes a huge driver and a big debate. And I can sit here and give you an argument why the currency will go back to 14 and why it's going to 20. I think you want to have some exposure to it continuing to move the other way. Another one we like is Mediclinic, where you have got some local exposure. Mediclinic hasn't adjusted That's what we've tried to do. Find shares which haven't adjusted properly to the currency. So Mediclinic, people forget, is less than 30% South African now. It's 70% offshore.
Swiss business with a secondary listing coming in London.
Sure. And the price hasn't adjusted nearly as much as the currency's weakened. So that's a share that we like. And then, across our top 10, I won't go through all of them. There's a huge dominance of offshore companies, but it has to be an offshore company which has some reason to grow.
But then you look at Richemont, for example. Richemont's performance last year was negligible. And it's got all the classic
it obviously came off quite sharply
Yeah.
offshore, but Richemont in turn is very exposed to China and Chinese demand. Their luxury goods sales are exposed to that. So Richemont, in fact, is in our top 10. That was an underperformer last year. It's come off significantly. If measured in foreign currency terms. You're now sitting at probably about a forward 15p multiple, and historically that's a pretty good valuation for a company of that quality.
Andrew, how brave are you feeling?
We're feeling more conservative and therefore looking at a lot of locally a hedge fund of fund type approach to the markets. I mean, it's becoming readily available for your retail investors. I mean, different platforms are launching different hedge type solutions, and just something that can give you kind of build a solution that can do 2/3 of the upside and 1/3 of the market downside. Because in this type of volatility, for your active managers, it really gives great potential to achieve alpha.
But you're then selling faith rather than people understanding exactly what they're buying, and that's often people go into these things, they go, here's the money, and they pretend they know what's going on, and there's an element of that which makes me a little bit uncomfortable. Simply because people don't know what they're buying. They're buying faith.
Absolutely. But I mean, now with the regulations changing and becoming more readily available to incorporate hedge in a portfolio, it's potentially going to be FSB regulated. We've been saying that for about 24 months. But that gives people another kind of sense of faith, and in the industry at least, because we've got a decent reputation for kind of vetting products, and there's good regulation here. I think that a selection of hedge funds within a portfolio is a good strategy, just playing to that non-correlation theme.
It sounds expensive though, Andrew.
You pay for quality. Unfortunately, it is an expensive asset class, but I mean, if someone's been doing 16% returns net and he's been charging you 4%, including his performance fee, well, I'd rather take that than someone who's given me last year a Satrix where you're paying 40 bips and you did 1 or 2%. So, I mean, you do.
It's an after fees.
Yeah, it's an after fees return. And then Adrian, just the one last stock pick, if we're going to push for that. Again, we launched a small cap portfolio last year, played well, good successes, and that did 15% for the year, not the 20s that Anchor delivered, but we're still happy with that given the backdrop of the market. And then the stock pick in there, which we continue to enjoy and support, is Santova. Okay. Plays to the free cash flow themes, predictable earnings, nice distribution network, mini UTI type business at a definite discount.
I'm hearing the name Santova more and more. Adrian, so you wanted to...
No, I was just going to say, well, Keith and I happen to be supporters of Santova for a long time, so it's lovely that it did have a good 2015. That helped us a lot. In terms of the hedge, perhaps just to recognize that not all hedge has to necessarily be 2 and 20, that you can put protection into a portfolio using very elegant and simple strategies. My colleague George Herman runs a protected equity portfolio. Superb results for 2015. And it has just 2 elements. The one is protection on the downside, and it holds 60% of the upside. So you get to hang on to that upside, and when the market falls, you've got a floor underneath you.
Yeah, and that's absolutely important. Okay, final question then. What must we not do under any circumstances from an investment perspective this year?
Buy resources.
Really? Okay, so avoid resources like the plague.
No, I just said that just triggered a debate because I want to see what
rebuttal Dr. Saville.
Come on this show.
We'll find you. We know where you live. But when it comes to 2016 from an investment perspective, not just from the bully perspective, what is the one thing to not do? He says don't buy resources. Okay, you're the value guy, says buy resources and hold.
No, I'm going to be a little bit flippant and say do not invest in any event on the back of a forecast that you've made. Your chances of forecasting with a degree of knowability that this is what 2016 will look like sets you up for mistake and misstepping. So build portfolios that are designed to cater for unknowability as much as uncertainty.
Okay, go back to the principle of get companies that are going to be bigger tomorrow than they are today. Good old-fashioned investing, basically.
Good assets at good prices.
Yeah, well, yes, it's called value investing, I think. From an anchor perspective, what to not do? If somebody in your office does this one thing and gets them fired, what is the one thing that's going to get them fired?
So I think it links into what Adrian's saying, is don't not have capacity. So what you guaranteed of is the unknown. There's going to be lots of surprises this year. We're not quite sure where things are heading. So have some, and that means you'll be able to buy shares at very good prices. So don't fully invest. Have some capacity to take advantage of the value situations, which you're definitely going to get over the next little while. And the other thing we do is probably avoid retail shares.
Okay, maybe despite Fushini's recent trading update, in which it was just massively surprising. South Africans over Christmas continued to spend on clothing and continue to spend on cell phones. Yes, it's history. It's quite recent history.
Sure.
But it does suggest that those who are, the few of us who are still employed in the South African economy, do still spend a bit of money.
Sure. No, there's support for these things.
Yeah, it's not entirely broken. And for anybody who's, as we go towards the end of the financial year, people who want to top up their RAs, for example, every year for the last 5 years, I've phased in my RA contribution over the 3-month period. And every year the market has solidly gone up for 3 months after February. It's really annoyed me. This year I'm extending it to 6 months because there is a good chance that shares will get a lot cheaper.
Sure. I mean, I think the range of possibilities are quite big at the moment. So you want to prepare for those, which means you can just kind of stick with quality. I'm much more interested in valuation of shares than probably a year ago. You want to be, when market goes down, you're not supported by valuation, but you're right. So one of the small cap shares that we're looking at that we love is Pinnacle. Come off from 24 to 12 Rand.
Pinnacle, the technology company.
The technology company.
Yes.
Yeah, we think the earnings will surprise. We think it's roughly a forward 5 to 6p multiple. Things that are just too cheap. Where if the market came off and it came off 20%, you can double your holding. Some of the more expensive shares, the market came off 20%, you wouldn't be buying more. You'd probably be, psychologically, you'd probably be wanting to get out of it. Yeah.
Deeply scarred.
Sure.
There we go, gentlemen. Thank you very much. Adrian Saville, Chief Strategist at Citadel and Canon Asset Managers. Peter Armitage, Chief Executive at Anchor Capital and Andrew Flavell, the Wealth Manager at AlphaWealth. 2 nights in a row. Big commitment. Thank you very much, gentlemen, for coming in. And thank you for watching. There'll be more on the Moneymakers tomorrow. Till then, thanks for watching. Bye-bye.